Hi guys, welcome back to my session. So students, we were discussing about the national income and related aggregates. Till now we had one session where we covered about the basic terminology of the national income, which covers uh, your what we understand by domestic territory, how it is different from the normal resident, what is an investment, what is depreciation, how depreciation is different from capital loss. So there were few terms that were left which we will be covering now. So the first one, it talks about net factor income from abroad. So NFIA generally it says that whatever the factor income that you are earning, the residents are earning from abroad, and then you will deduct the factor income that is earned by the non-residents within our country. Now this income, while we talk about this factor income, can be in various forms. It can be in the wages, it can be in the form of rent, interest, dividend, it can be in form of retained earnings as well. So this we have divided under the three components. Okay, the first one is the net compensation of employees. So when we talk about the net compensation of employees, it simply says that whatever the wages that are earned by the residents in abroad, and then you will deduct the wages that is earned by the foreign resident, or you can say the non-resident in India. So net compensation, it generally talks about the concept of wages, right? And those who still do not have a clarity as to what is the difference between the resident and the non-resident, they can please go and see my first video of NIA, national income. There I have clarified what is a resident, how it is different from a citizen. So the concepts will be clear there. Okay, then the second is the net income from property and entrepreneur, right? So this basically talks about in the form of rent, interest, dividend that is earned by the Indian residents in abroad, in rest of the world, and you will deduct the rent, or you can say the interest that is earned by the foreign resident, non-resident in our country, India. That is what NFIA talks about. Then the third component, it says, is your net retained earnings. Now net retained earnings is basically when we say that retained earnings as nothing but in a company, generally if there is a profit that has been earned, first we pay it as a tax, corporate tax. Then we also divide the dividend among the shareholders, and whatever the profit is then left with us, that is known as our retained earnings of a particular firm. So whatever the retained earnings that the Indian companies are earning, which are located abroad, that will be, we will be earning, and we will be deducting the retained earnings of the foreign companies, which are located in our own country, India. So this concept, generally if you say, this basic concept remains the same. However, the only bifurcation that they have made is, they have divided under the wages, rent, interest, and over here retained earnings, dividend. So this is basically nothing but it's generally talking about the factor income that is earned by the residents abroad, minus you will be deducting the factor income that is earned by the non-resident within our country. Maybe it is in the form of the wages, maybe it is in the form of the rent, interest, dividend, or the retained earnings. So this is how we bifurcate amongst the net factor income from abroad. And one more thing while we move forward, there are a lot of hot questions that ask you that can NFIA be a negative, can NFIA be a positive, can NFIA be a zero. Then always please remember, all these possibilities are very well applicable. NFIA can be negative if the factor income that is being earned is less than factor income which is paid. It can be negative. It can also be equal when the factor income from abroad is exactly equal to the factor income to abroad. So this is generally a one marker which is asked. Now after this we have discussed, we'll move on to the conversions. This is very very important. This is again a basic thing that we will apply before we understand the concept or before we start calculating the national income or the domestic income. So the conversion simply says, this first pointer of conversion is the MP. MP is nothing but the market price. So an FC is your factor cost. So always remember, this is a kind of subscript which we will be using in the calculations ahead. So whenever we need to convert the market price into the factor cost, we will always be deducting the NIT, which is net indirect taxes, and this NIT is nothing but the indirect taxes minus the subsidies. Okay, vice versa, in case you want that factor cost should be converted under the market price, then you have to add the NIT. Okay, when we net is nothing, net is the difference between the indirect taxes and the subsidies. Now majorly in the questions, it is not necessary that whenever you will be solving the question, so IT or the indirect tax will be mentioned. They might mention the GST. You should be aware that it's a kind of your indirect tax. So till now 12th class students, you must be aware what are your direct taxes, what are your indirect taxes, your excise duty, your custom duties. All these are a sort of your indirect tax. Your corporate tax, your income tax, all this is what? This is your direct tax. So the next conversion is that gross and net. Till now, if you have done the concept of depreciation, or you have seen my first NIS video, you must be knowing we have done the concept of gross depreciation, right? So gross generally includes depreciation, and whenever you want to exclude depreciation and you want to convert it into the net, you will always be deducting the depreciation. And the other word of depreciation is consumption of fixed capital, replacement of fixed capital. So these are the various names given to the depreciation. Whenever you want to convert the net into gross, you will be adding the depreciation. So this is the next conversion that you should be aware of. Okay, then the next one that we have is the difference it talks about is your basically national and domestic. So whenever you want to convert your national income into the domestic income, so this concept talks about the NFIA, which we just covered. So whenever you will be converting the national into the domestic, you will be generally be subtracting the NFIA, and whenever you want to reach the concept of the national from domestic, you will be adding the NFIA. So these are the basic conversions that you should be knowing. I'll let you know how the questions will be solved ahead. So there are basically 3 methods that we will be covering. So one is your value added method, one is your income method, and the other is your expenditure method. So over here students, if you see the relationship, just see G and N. If I say I want to, let's talk about this conversion. If I want to convert GNP at MP to NNP at MP, so this first I'll pronounce as at gross national product at market price. So if I want to convert my gross into my net, you just did the previous slide that we will be deducting the depreciation, see, like this. Okay, then if again, so simply one conversion is possible. Now from NNP I want to go to NDP at MP, which means from net national product at market price, I want to go to net domestic product at market price. So whenever we move from national, the second number is national and domestic. So whenever we move from national to domestic, we will be deducting the NFIA, net factor income from abroad. Let's see the third conversion. If we want to move from NDP at MP to NDP at FC. So MP and FC, basically these are your subscript. So whenever we move from MP to FC, we will be deducting the net indirect taxes as we just did in the previous slide, right? So So this should be in your tips. NDP at FC is nothing, but we also denote it by the domestic income. This NNP at FC is denoted by the national income. So these are the various conversions you should be aware. The first is the gross or net. The second talks about the domestic national. Third talks about the market price or the factor cost. Again, I'll talk about it over here. First talk about the net or gross. Second talks about the domestic national. And the third talks about the MP or your FC. So till now you should be aware that what is your national income? All the final goods. Please remember, all final goods produced by the residents, normal residents. We are not concerned whether they are in the domestic territory or not. Two things to be kept in mind. Final goods and services produced by the residents, both, if they are working within or outside the domestic territory in an accounting year, in that particular financial year, then only we will be considering this as a part of your national income. So I hope we are clear till here. Okay, so moving ahead, now what is gross domestic product at market price? This simply talks about all the final goods and services that are produced in the domestic territory. So your national income, NNP at FC, is not concerned whether it is domestic or national, but the GDP at MP is concerned with the domestic territory. Now in national income, what things are not included? The basic things that you need to keep in mind, and then of course we will discuss it method wise. So it should always exclude any second hand items, because we are talking about the final goods and services that are produced within the accounting year. So the second hand goods are never included because they were already included when they were produced in the current financial year. So second time we do not include it because it will again lead to double counting. All the illegal activities, because it does not generate the productivity, it is not a two-sided transaction, so we do not include it. Also we do not count it in our accounting book. So that is why these illegal activities are not to be included. Any kind of transfer payment, transfer incomes, unilateral transfers, not to be included, because that is your one side payment or one side income that you are receiving. It does not generate the productivity of our economy, so we will not be including them. Okay, so basic difference, because see, this is your domestic income. Always remember your domestic income is represented by NDP at, this is not MP, it's denoted by NDP at FC. This is your domestic income, not by MP. Okay, then the next one is your NNP at MP. So this is a basic difference you should be knowing. If they ask you under 3 marker or 1 marker, so you can say that it's a domestic concept. However, this is a national concept that we have. It includes the this particular, this does not include your NFIA. However, this includes your NFIA. So till the time you are very, very clear with the conversions, you will be able to solve it. Now, as I told you earlier, there are 3 kinds of methods that we will be discussing, and the first one is your value added or product method, the second is your income method, and the third is your expenditure method. Now, why these 3 methods are there? See, first the economy produces, as we did in the circular flow, if we can recall. So as the economy produces particular goods in the country, so accordingly we will be generating the income out of it. And the income method then talks about how you are distributing, like in the form of rent, wages, interest, profit. And expenditure method, how disposition of your income, that how your expenses are managed in the economy, who is getting what, someone's income is another's expenditure. So all these 3 methods are interconnected, and always remember, you are calculating whatever terminology that you want, whether you are calculating national income NNP at FC, whether you are calculating domestic income NDP at FC, whether you are calculating GDP at MP, all these three methods will give you the same answer. It is just the way, these are three different ways to calculate the various national income and domestic income, but you do it with whichever method, the answer remains the same. Okay, so the first one we will cover the value added method, and I've tried to take into account all the terms and all the formulas that could take place over here. So whenever students we talk about the value added, whenever we are adding some value to a particular commodity, it takes place initially by what is the sale. Okay, so what is the sale of that particular commodity? And you all know, we all are aware, in microeconomics also we did in class 11th, that sales is nothing but whatever the price is there into the output sold. Now this sale can be, we know we are an open economy, so we know that sale can happen within the domestic territory, which is also known as by the domestic sales, and the sale can happen with the rest of the world, which we always term as the word export. So if domestic sale is given in the question, you will be adding export. If only sale is mentioned, then you will be considering it as the total sales. Then we have the change in stock. We all know in accounts also we do this. It is basically the closing stock minus your opening stock. So value of output is nothing. Whenever we add sales plus the change in stock, we get the value of output. But having said that, value of output do not restrict till here. We also need to take whatever the intermediate consumption or whatever in between the process of making that particular commodity was used as a raw material. So that intermediate consumption includes whatever you are purchasing the raw material within the domestic territory or anything you are importing from the rest of the world. So these both the things include under the term which is the value of IC, and we deduct this particular values from the value of output. Then only we will get how much value has been added to our commodity. Otherwise, if we do not deduct the IC, it will again lead to double counting. Double counting means you're counting the items more than once, and it will lead to overestimation of your national income. It will not give a true picture. That is why it's very, very important that you deduct the IC. Clear? And this has been a part of one of the CBSE exams under 1 marker. So always remember the sum of the GVA, the sum of the GVA at MP, that is actually give this particular GVA, it actually gives us the GDP at MP. So whenever you will be deducting the intermediate consumption from the value of output, you will get the value added. When you sum all these value added, you will get GDP at MP. Okay, so always remember this particular point. So we will cover it here also. So if we have three sectors, so GVA, sum all the GVA, we get the GDP at MP, as I told you in the previous slide. Now, if they say you from this GDP at MP, you have to calculate the domestic income. So you will be deducting the depreciation and the NIT in order to get the domestic income, which is your NDP at FC. And in this, you will add your NFIA and you get your national income, which is your NNP at FC. So this is the protocol that you need to follow while you're calculating the numerical. Okay, very important, the process of your value added. So this particular question also generally comes for 3 to 4 marker in your exam. So let us understand this particular tabular representation. So this is one of the example that we have. So there was a farmer, his product, he was producing cotton. Initially there was no IC involved over here and there was a value of output of 1000. So what will be the value added? Value of output minus the IC that we have, which is 1000. Then this 1000 was carried forward. The thread manufacturer used this cotton and he added this as the value of output, which came which came out to be 1500. Now for him the IC was his 1000 rupees. Okay. Sorry. So when he deducts this, he'll get the value added as 500. Okay, now this 500 is used as in, again, the value added that we are counting over here, we will put it here. Now this thread is again used by the cloth mill. So the cloth mill now produces for him, the product is the cloth, right? So he uses at 1900, right? 1900, and for him this becomes the IC. His, he is deducting all the IC, like over here for the thread manufacturer, IC was 1000. The cotton for a thread manufacturer will be his intermediate consumption. For a cloth mill, the IC will include this 1000 which has cotton and thread. So over here 1500 now becomes his IC. So what will be the value added? 1900 minus 1500, which gives us 400. Now for a ready-made garment manufacturer, he is producing shirts, okay, and for him he have placed the value of output as 2500. Now if it is 2500, so for him IC will be all that which has already been included earlier. So if he doesn't take this IC 1900, then it will lead to an overestimation. Now see over here, we have just taken the value added, we are adding it up, and this is the value added. 2500 is the actual value which has been added in this entire process. However, if we take these numbers, this will give us 6900. 6900 is such an overestimated figure, if you realize, because over here it includes all your IC, intermediate consumption, which you used in between. However, if we deduct this IC, which is 4400, it will give us a true picture that the value that has been added to the product is only 2500, not the 6900. So here the 2500 value added has saved us from any chaos of creating double counting, which was included in this 6900. That is why it's very important to deduct the intermediate consumption, or intermediate consumption are basically the raw material. So for a ready-made garment manufacturer, the raw material will be cotton, thread and cloth, right? So for him it is the if he doesn't exclude this raw material or the intermediate consumption, the value that is representing will be misleading, and accordingly your national and domestic income will not be the correct that is reflected. Either take this as the value added, or the other method is that you can also take final output. This final output is the last product that is being manufactured. This is also of rupees 2500. So either final output method says you take the value of the final output that the particular product reaches, or you take the value added by adding all the value added at each particular stage. So this is how this needs to be covered. So after doing the process of value added, we should be knowing that self-consumption items, product, value of production for self-consumption will be included into account. However, the value of services for self-consumption will not be included, right? Like the services of housewife is not included, a doctor teaching, a teacher teaching his own son is not included. So all the value of this self services that you are using, that is not included. However, if a farmer is growing vegetable in his own garden, then he is consuming that particular vegetable or fruit, so that will be included. So products for self consumption are included, but not the services. Okay. Sale and purchase of second hand, I've already discussed that this is not included. However, if the commission is earned by the dealer of the second hand, because that's a fresh transaction that is taking place, the commission is the first time he is getting any commission. If he is dealing with any second hand good, then that will be included, only the commission. Of course, we know ICs are not included. In the previous slide we have covered the process, and we also covered the formulas in the value added method where we are deducting the IC, so definitely we will not be included. And imputed value of owner occupied houses should be included. That it basically means either you're living on rent or you are living in your own house, but it has some value attached, it has some rental value attached, so that should be counted. Otherwise we will not get to know the price of the particular asset that is taking into account, whether it's your own house, but still there is a value to your house. What is the rental value of your house? It does carries a weightage. Generally these are appreciable in nature, so we will be taking into account. Okay. And change in stock, of course, it is included whenever you are calculating the value of output. It says sales plus change in stock, so change in stock will be included over here. Okay, so let's do few numericals related to value added, since we have just covered this particular method right now. So it will be very quick if we could simultaneously do the numericals also. So over here it says that we need to calculate NVA at FC. You always, if it is written VA, you treat it as DP only, okay? Because the sum, if you remember, the sum of all the VAs, value added, is domestic product. So this basically means that you have to calculate GDP at FC. Okay, let us see now. So it says that first of all we should recall that our value added is nothing but value of output minus our IC, and value of output is sales plus change in stock. So similarly over here we know sales is given, change in stock is 10 minus 20, which is a minus 10. Okay, so we will 540 minus 10 accordingly, and then we will deduct the IC. So they have not given you the perfect IC into account, but purchase of raw material is nothing but our IC only, so we will be deducting this. This will ultimately give us GDP at MP. Now your conversion comes into place. You want NDP at FC. So what you will do, in order to convert the gross to a net, you will deduct depreciation from, and depreciation is mentioned over here, consumption of fixed capital. If you have to move from MP to FC, you will deduct NIT. So NIT, so this is your indirect tax. Subsidies are not mentioned, so we will treat it as 0. So we will only deduct 25. Okay, so now let us just see the solution. I would want you people also to please solve it ahead, and let us see what answer do we get. So this is how you have to follow. I hope everyone is getting 360 crores is the answer. Always write in the full form initially. It's very, very important. Otherwise we lose mark. Always attach the unit, put the crores. Otherwise again we lose half a mark. So this is how we will be solving the numericals. Okay, let us move to the second. It says gross value added at factor cost. So over here we have sales. Let us see change in stock over here, 20 minus 10. So we'll add 710. Then deduct your IC 400. It will give you GDP at MP. Now all you have to do, you have to convert MP to a FC. So you will deduct the net and indirect taxes. So net indirect taxes is what? Indirect taxes, for 40 is your GST minus 5 is your subsidy. So you will be deducting 35 over here. Okay, so this is how you will be solving your numerical. Okay, so students, you can always refer Sandeep Garg. It has beautiful questions over there for your value added method. So these are few that we are practicing over here, but in order to have a good hold over the value added method, I would want all of you to please complete the solved and the unsolved questions of the value added from this particular book. Okay, now they say that calculate the value added by firm X and firm Y. So there are two firms that they have mentioned over here. So first let us focus on the firm X. Let us see what is the sale of this firm X. So over here it's written sales by firm X, it's a 300, right? And then of course you will see closing stock minus the opening stock. So over here the closing stock is a 20 minus the opening stock, it is a 5. So this is how you will get the sales plus change in stock. Now you have to deduct the IC out of it. So IC will be deducted. See over here it is written purchases by X from firm Y. So this is the purchase by X, and whatever the X is purchasing, that will be the IC. So over here we will be deducting 100. Okay, so this is how you will be talking. Then of course they are saying import of raw material by firm X. So we will have to think whether we will be taking this into account or not. Just think over it, and then I will of course, we will solve this particular numerical. So of course the import that is mentioned, that will also be deducted. So under the IC, right? Now, so what is sales plus 300 minus your IC plus your change in stock? So over here, whatever the purchases we have taken from Y, whatever we have imported, raw materials, had the only word IC been there, then we would not be taking these two in account. But since IC is not there and we have been mentioned purchases and the imports, then we will be considering the import also. Change in stock, as I discussed earlier, is this. So ultimately this is your, sales minus your IC plus your change in stock. It gives you 165 lakhs. Now moving to the previous slide, let us look for firm Y also. So for firm Y, sales is 250, and what are the purchases? It's 80. Let us see any other detail is given. Yes, so the closing stock is 15 minus your opening is your 10. So 5, you'll add 5 change in stock over here. So see, sales is given, you will be adding sales. Purchases is 80, deduct your IC, which is your purchases, add your change in stock, and you get value added for your firm Y. So that's all you had to calculate. Okay, now this was the entire explanation of the value added. In case you have any doubt, you can put it in the comment section. Any question you feel is not able to solve, so you can put it there. So that was all for the value added. In the next session we will be covering about the income method. Okay, thank you so much everyone for watching the video. So do let me know if any changes are required. We can always give the input, right? See you next, and we'll cover the